Hey everybody, this is Paul doing a quick dividend video. It is March 28th, 12:35 Central Time. I think the market's still open. I don't know if they're closing early today, but since Easter or Good Friday is tomorrow, and then over the weekend it'll flip into April. Figure this is a good time to get a video out since there won't be any more updates for March. I already got all my dividends paid out and whatnot. Well, I still have some things from like E-Trade, but it's like 10 cents. But because I have nothing at E-Trade. So I guess let's go over the market here and just kind of go over the big things that happened in the last 15 days or so. Pretty large moves, at least in my portfolio. Um, so right now, I guess I want to do more like a Q1 kind of review type thing. So that's where I'm at for Q1 or for March, which is a pretty nice gain. And if you look at it, so if I go for March, like say for example here, one of my goals was specifically to try and capitalize on tax returns, and I think I've done a pretty solid job of doing that. Take as much money as possible from the gig work, and then basically just throw it into the market. So $2,605 alone there. Um, just different things. Like my spouse has, a pretty good job now, so she's gonna have her, or you should see the savings number right here going up. Uh, that's just a high yield savings that I got for her, just to put her money somewhere, just to save it. And I put the cash, the money market fund cash that was sitting here in the SPAX account, in Fidelity. I put that to work in the stocks, and it's obviously paid off in a pretty large way. And then, as you can see, yearly dividend is astronomical now. So large, record yearly dividend, even no matter how far back I go. Um, so I guess the real question is does it continue? Do things feel like they're richly valued now? So you have to look at what caused our current situation. So what caused the current situation is the dots. Oh, the dots. So the Federal Reserve came out and basically a majority of the members, a decent majority of the members, said that they were going to do three cuts still. Now, after January and February saw some what I would call one-time seasonal adjustments, auto insurance renewing once a year, homeowners insurance renewing once a year, Medicaid negotiation price adjustment rate type stuff renewing once a year. I I was on the side of the camp that basically said the Fed would look at that, realize that it's once a year things that happen in January and February, gets adjusted in the seasonal type stuff, and then they would look at the actual data like food, gas, that type of stuff, and they would realize that that's one-time stuff. It's not every month that your car insurance is going up by 20%. At least I hope not, or nobody would have car insurance. So a majority of the Fed members still agreed that it was something to watch, but it wasn't taken off quite yet. And as you can see, if you know how to read dots, it's pretty much what this is kind of saying is that when they expect cuts, that type of thing. So that caught bears off guard because bears were expecting them to knock it down to two cuts or no cuts. Some people were saying no cuts, which would have immediately caused a sharp sell off, a very, very sharp sell off, which didn't happen. We probably could have retested 4,800 to be honest with you, if they had said no cuts. So we got that. Um, and then there's just different things that are going on with the U.S. economy that's making it so we just don't have the problems that the rest of the world has. So parts of Europe, large parts of Europe, they're in recession. As you can see, like they've raised their rates, but they don't have long-term financing like we do. So there's a reason why Germany's in recession, but France is not in recession. Not only is it the power issue in Germany, also that's they turned off most of their power, but as you can see, one big thing that's going on is when you raise rates in Europe, it affects each country differently. When you raise rates in Australia, you can see here variable. Look at 1 year fixed every year. You might as well just have an adjustable rate mortgage at this rate. But look at the U.S. Long-term fixed greater than 10 years. That's 30-year mortgage. 96% of the mortgages in the United States are like that. This, trust me, if you look at this chart from like say 2005, 2006, 2007, it looks more like Germany, to be honest with you. Instead of saying this, I would just say adjustable rate or something like that. But I mean, we have dramatically changed the composition of mortgage makeups in this country after 2010. Like people just don't do adjustable rates anymore. As you can see, this right here, it's only 3% of the market. So that's been the big thing that's been making it so that most consumers, 65% of this country, has not been affected by these rate cuts, really. Like these people right here in this 96%, they're complaining about gas and food. That's who you're talking to. They're not talking about mortgage rates. Like, so that's kind of one thing that's going on. And I don't understand how smart people miss this. I just don't understand. I have not understood since 2021 when they started talking about rate increases and people started talking about like the Great Depression and housing being sold off and everybody losing their house and I never even predicted a recession, or I never came close. I came kind of close to predicting a recession if they didn't pause, but they did pause. So also here's what's been propping up the market. Here's a big thing. I guess I don't know if bears forgot, but companies buy their own stock. It's just a thing that they do. Um, this is kind of where you can kind of get the general idea. Companies saw these low stock prices. This is in the middle of 2022. Uh, Market had one bottom in 2022, and then another, or in June of 2022, and then it actually bottomed in June of 20 or October of 2022. And look when companies were buying their own stock. Like there's been support for the markets out there the whole time. It's just bears haven't been paying attention apparently. And then if you go to this great chart that I just linked 2 seconds ago from Kathy Jones, if Twitter would bother to load. So if you look at this, corporate profits rose to an all-time high in Q4. Bears don't have an answer to this. It's very simple. Bears just do not have an answer to this. Now, there's some people that are saying it's not inflation, it's greed kind of thing. It's possible, but not every company is relying on pure consumer type behavior like selling chips kind of stuff. Smaller bags of chips with higher prices. McDonald's, I kind of, they raise their prices and whatnot, and they're getting pushback. But not every company's like that. So corporate profits are at an all-time high. So bears are running out of excuses. Now, have bulls gone too far in the other direction? I think we're definitely getting there. I believe linked something yesterday from Jurian Trimmer, who's an economist for Fidelity, and he said the market is valued at say 23 price to earnings right now. That's a lot of catching up to do. Um, so what are funds doing at the end of the year? Is they're just diving into things that haven't been touched. Um, Mostly value. So that's pretty much my portfolio, which is kind of funny. It's actually kind of depressing. If I had known this was coming, I would have held off selling SPHD. But it's worked out for me because they're also buying this type of stuff. BBN, they're buying BSTZ, they're buying BST, but they have dove into SPHD with a vengeance. Uh, or the underlying stocks of SPHD is a better way to word that. So as you can see in the last, say if you just go to 1 month, for example, like SPHD has gone from 41.92 up to 44.38 today. And I believe it has a record high of 48. So, yeah, that's certainly something. So this to me looks like a typical bait and switch that I see at the end of quarter. So every 3 months I see this, especially when it comes to something like SPHD, for example, SCHD, any of these stocks that hold these types of value plays at the end of the month. You get a lot of funds that rotate into these things, and then at the beginning of the month or the beginning of the next quarter or sometime in the next quarter, they just dump it. Um, it is kind of a weird little trend that they do. So you can kind of see it goes through these little cycles. It runs up and then like right at the end of the quarter, and then it just drops. You could probably see it here. See how it like kind of runs up March, so March 28th, for example, 2022, and then it does that, and then it just dumps. There is a history of this where funds will do this stuff right here, for example, and then they just kind of dump it. It's so weird how they do it, but it's at the end of the quarter they rotate into value for some reason. I've seen it so many times it's not even funny at this point. But I think there's a good chance that this pulls back. I mean, it's not my main focus this year anyway. So as you can see, this is the current portfolio. I've made significant progress towards my goals um, already in March, going into April. I've already made significant progress towards my goal of $100,000 this year. uh, well on my way towards it, unless the market just completely dumps. I even did some math yesterday that if we have a 20% correction, this is the only part of my portfolio actually. This top part right here is the only part of my portfolio would actually be affected. So that's kind of where we're at right now. Um, what do I expect for the next quarter? I think the market has run a pretty solid amount that we can justify a 2% pullback right now without people freaking out. Um, if this market corrected 2%, I would not be shocked right now, just where valuations are. This was another thing that was supposed to like cause the market to crash. This was a bear thing that was is supposed to cause the market to crash. Is that there was roughly about $110 billion worth of debt that was set to mature this year, I believe. Um, where's it at? Yeah, there we go. But yeah, there was about 100 billion, or there was a lot of debt that was set to mature this year that people were not sure if they were going to be able to finance a lot of this debt that's out there because those pandemic rates are just kind of going away slowly. That's what higher for longer is. So the longer that, and this is also just the U.S. Treasuries also, as you can kind of see, government keeps issuing debt, that type of thing. But as you can, it's basically just these debt walls, as we call them, I guess if you want to call them. These companies they're having less trouble than expected refinancing their debt, and that's the credit markets. That's what the Fed actually cares about. So here's a chart that somebody posted the other day, kind of showing some little different things that could happen in the market here and where they think the upper part of the range is. This is very technical stuff that I can't even hope to begin to explain, but basically, a lot of people are kind of looking at this 5,600 as maybe where we top out in this market. Now, how do we get there? When do we get there? Or what's the path? How many ups and downs do we have between now and then? Do we go back down? Do we do this? Is this purple box way over here? Type of thing? Probably. We would need some pretty significant earnings to justify that. If we just run up to 5,600, I'll go all cash. I'll tell you right now. You'll open this video one day and you'll just see me sitting in cash if we run up to 5,600 that quick. Because that would extend this market out to 1999 type levels. And there's a lot of evidence that it feels like possibly we're in a 1995 scenario and the market ran for another 4 years, or maybe 1997 scenario. But there's room to run. And if you're not comfortable, nothing requires you to touch Nvidia. Nothing requires you to touch these companies that are very expensive, especially like SMCI or DJT or whatever insanity. Nothing requires you to touch these companies if you think they're expensive. So that's currently where I'm at right now. The plan is to finish off BST or BBN, which I should be able to do. Another 12,000 there. Should be able to do that pretty easily. Especially when dividend investing on helping out a lot. It's an extra 171 a month now. Um, Pile all my money in there for another 12 grand. I changed the weightings here because I want more exposure to O. So I got to change that to a light blue now. So there's O. So what I want to do is after I catch up on right here for BBN, I want to go back to O and add it so that it's at 107. So it's purchasing effectively right around 2 shares every month. and then that's where I'll go with that. Let me update that date. So the big goal is BBN. Finish that off, get that up to 237, and then kind of shift back over to O. As it's staying cheaper much longer than I thought it would be. I thought of all things that would kind of if I saw SPHD start to run, I thought I would see O start to run, but O is far more interest rate sensitive. So if they don't cut in June, that's where this is going back down to 51 or 50 for sure. So that would be a nasty little hit. But if SPHD is richly valued, I don't have to do SPHD. There's nothing that says I have to do SPHD. So I can go back into O and say, okay, O's still cheap. SPHD, the highest it ever got when rates were at zero, just about was 48. So, if I think which one is going to run the most, O was sitting at 80 something when it was at its peaks, all time highs kind of stuff. So, I think O would probably be my focus after BBN. And then, obviously the goal is to pile more money into BBN. So another 12 grand would take me up to 92. And then I got another 6 grand or 8 grand to go, and I'm at 100,000. Boom, there you go. That's my goal for the year. Boom, boom. And the reason why I'm able to do that, I don't want to make this video too crazy long, but the reason why I'm able to do that is very simple. Last year, my total invested was 55% out of 32. This year, it's 70% out of this much now. So that's one of my goals, and that extra 15% is making a dramatic difference on how quick I'm able to achieve these goals. And I actually want to increase that to say 75 once I get around, like say, gas and all that kind of stuff. So definitely on track to hit the goals here. So let me know what you think. Leave a thing in the comments, and then y'all have a nice day. Thank you.